Hello, everyone, and welcome to today's webinar, Breaking Down Eurodollars, the most important, least understood market in the world. This event is part of our Institutional Access webinar series. I'd like to invite our speakers to unmute their lines and turn on their videos. During the webinar, please submit your questions through the Q&A section at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand. All registrants will receive an email once the recording is live. I'd now like to turn the event over to Michael Ippolito, co-founder of BlockWorks Group. Mike, please go ahead.
Julie. And hey, hello everyone. Thank you so much for joining us today. We've got a really special episode of Institutional Access. I'm very lucky to be joined by Snider and Brent Johnson, who I'll introduce in just a minute. But first, just a quick 20-second overview on BlockWorks Group. So BWG, we are an events and media company that shines a light on some of the most interesting and relevant issues from a macro investing standpoint today. In happy or non-COVID times, we host a series of live events. And we also produce a series of podcasts and webinars, which is what you're watching right now. So today's episode of Institutional Access is all about the Eurodollar market, or the Eurodollar system, as our friend Jeff would say. So like I said before, I'm very lucky to be joined by some of the, I'd say the world's most leading experts on this particular space. So without much further ado, I'd like to introduce our two guests, Jeff and Brent. Gentlemen, if you wouldn't mind just giving a quick 30-second introduction for yourselves for the audience.
Okay, sure. I'll start. My name is Brent Johnson. I have a wealth management firm in San Francisco called Santiago Capital, and I do a lot of work in the macro space. And the dollar and the euro dollar has been a focus of mine for the last 2 or 3 years. So happy to be here and talk about it.
I'm Jeff Snider. I'm with Alhambra Investments, a registered investment advisor in Florida. My role here is to try to inform our portfolio managers of what's going on, not just in a macro context, but in a financial and monetary context. And I've spent a couple of decades now researching, following down this rabbit hole of what we call the Eurodollar system, which is really a monetary black hole or black space that's been unexplored for 40, 50 years for reasons I hope we get a chance to get into. But essentially, it's a shadow money system that is literally in the shadows.
Excellent. Thanks, Jeff. And that black hole, it's a black hole, so this is actually going to be a 20-hour webinar, as we were joking before. So I hope everyone's ready for that. No, it's a really interesting topic, and we're going to do our best to just condense some of the most relevant points into the 1 hour that we have today. So thanks, gentlemen, again for being here. And without much further ado, let's just dive in. So there's really a lot to cover here in the Eurodollar system. I'd like to begin with just a basic sort of glossary terms and one of the contentions that I think both of you has made, which is just starting with the US dollar as a reserve currency. I think that's kind of the general understanding, but as both of you have mentioned before, the US dollar is kind of a reserve currency in name alone. And there's actually another system, which is the Eurodollar system, that practically functions as a reserve currency for the rest of the world. So there's a lot to break down there. But I'd love to just start with examining that contention that actually the US dollar is just one part of the central reserve currency system, and there's a much more important and larger Eurodollar system. So whichever one of you wants to start to go with that, that'd be great.
Well, first of all, I mean, the term Eurodollar itself is somewhat of a misnomer. It has a traditional historical use, which was, currency, U.S. dollars that were on deposit outside of the United States. And so it represented exactly what you're talking about, which was the U.S. dollar as the reserve currency. But this Eurodollar system, which is a more comprehensive bank-centered system that developed over the decades since around 1955 or so, that's more encompassing. And it's the system itself actually undertakes the roles of the reserve currency, even though the US dollar is preserved as the overall denomination. So we call it the US dollar, but the actual functions of that reserve currency, the monetary functions of that reserve currency, are provided by this overall system, which is far more than US dollars on deposits in banks around the world.
Yeah, and I think I would add that the origins of the euro dollar market are a little bit as, maybe not quite as murky as the market itself, but similar. It started back in the 50s post World War II with the Marshall Plan, the United States financing the rebuilding of Europe and, getting dollars into Europe. And so then you had dollars in Europe, and that's kind of where the name euro dollar came from. It continued through the 60s and 70s, and, in the 60s and 70s, Nixon wanted to finance the Vietnam War, but he didn't want to do it through French banks. So we started opening up American banks in Asia to help finance the Vietnam War. And so that kind of contributed to it as well. And it really, I think sometimes people hear euro dollar and they confuse it with euros, which should not be the case. Again, the thing that makes it such a mess, in my opinion, and I'm not sure if Jeff agrees with this or not, but it is two systems, but they're intertwined, and there's some fingers that kind of stretch across. And in both systems, it is U.S. dollars, and there's only two entities, the Federal Reserve and the Treasury, that can supply dollars. But half of this market, or more than half of this market, or the euro dollar market, the euro dollar half of the overall dollar market, has no regulation. It has no entity out there who oversees it, so to speak. So it's really kind of become this spider web of dollars around the world, some of which are regulated and some of which are not. And it becomes incredibly hard to decipher all of it just because there is no regulation. Anyway, I'll leave it at that for now.
Well, Brent, I think that's a really good point, especially, people are taught and we're told to conceive that, hey, it's the Treasury Department, the Federal Reserve. That's the only place that U.S. dollars can come from. And therefore, what are we talking about? And I use the example, look, the Fed can print Federal Reserve notes, the physical paper that have numbers
Right.
and all the symbols on and whatever. But as a bank, and if you're a bank and I'm a bank, we can create as many IOUs that say that we have dollars as we want. And so it's a step removed from any actual currency system. And in many ways, it's a quasi-currency system of one that's entirely ledger money. In fact, that's one of the reasons, we talk about the origin story. One of the reasons the Eurodollar market took off, and especially in the 1960s, was because it was freed from the need to ship gold bullion around all parts of the world. It was then freed from the need to ship actual physical currency around. It was simply, with the revolution of technology, the immediacy of transactions, as long as my computer screen, the numbers on my screen match the numbers on your screen, we've got money, we've got dollars, we've got something's going on here that's monetary in nature and financial in nature. And so in many ways, physically detached from the physical supply of currency and becomes its own currency.
You could argue it was the first digital currency, the first global digital currency, because it's used all over the world.
Yeah, exactly. Crypto is nothing new. I mean, they were doing this stuff back in the 60s.
Digital form. Yeah, exactly. It really was, and it still is, probably, other than the Bitcoin and the digital asset market right now. I would argue that the euro dollar market was and still is sort of the wild, wild west, because there's sort of rules around it, but there's no agency that can actually enforce it. So it's just kind of a mess, for lack of a better word.
Yeah, and that's a great point too, because we're all taught to believe that the rules are always given top down. Like bank regulators, central banks, whatever, they give the rules to top down. And the Eurodollar system is the exact opposite. There are rules, but they're bottom up. It's how banks construct their balance sheets in individual cases that governs what those balance sheets do in the aggregate. So it's not a central bank dictating to all the banks. It's all the individual banks within the system, operating within the system, that use their own set of rules to dictate how they participate in it, which makes for, as you pointed out, Brent, a far messier situation, especially when you can't really get a handle on what's going wrong, or if something's going wrong, what is it, when you have a bunch of individuals working.
Yeah, and I think we're going to get into this later, so I won't go into super detail right now, but the reason it's a problem, in my opinion, is because of the design of the monetary system itself. The design of the monetary system is a fractional reserve system, which means money gets loaned into existence. And that's fine as long as expansion continues and the extension of credit, which creates more money, continues. The problem is that in the fractional reserve system, when it starts to go the other way and you get a contraction, you have a very high likelihood of contagion, and where one loan kind of collapses onto another loan and you go back the other way. And in that environment, in a fractional reserve system, you need a central bank or a lender of last resort to kind of come in and recollateralize the system. But because there is no entity outside the United States that can create dollars, for lack of a better word, or new collateral, there is no regulator or no entity to help stem the problem from a collapse if and when it comes. Now, there's been a number of, little patches here and there, but there is no systemic way to actually solve the problem, or there's no current way. There's no current function. There's no current mechanism via which they can solve this problem.
It's all right, Brent? This actually happened. I mean, that you basically just described 2008 down to the, that's exactly what happened in 2000. That's why we had a global financial crisis in the first, and that's why it was a global financial crisis.
Yes.
Because we're talking about a global currency. Therefore, as it fell back in on itself, with nothing to stop that process from taking place, contagion was it spread all over the world. No parts of the world were unaffected by what happened in 2008 because it had very little to do with subprime mortgages. It was about a global dollar shortage in the Eurodollar system, which the Federal Reserve, the U.S. Treasury, whatever, they're just not connected to it. And therefore, even if they wanted to, they believe their mandate ends at the border of the United States, and therefore whatever happens in dollar terms outside the United States is somebody else's problem. But that's the point. There's this unofficial black space where nobody even knows who's responsible for it, let alone what goes on in it.
Right.
Yeah. And guys, before we get too deep into the problems, I just want to make sure that everyone's on a level with what we're talking about here. So it seems like what we're describing is two distinct monetary systems, right? There's the traditional kind of top-down monetary system where the US dollar is the federal or the reserve currency, and it's regulated by central banks, right? Which is the one that we all kind of know and think about existing. But what it seems like you're both describing is another unregulated, almost emergent monetary system, right? Which is this Eurodollar system, which is actually created by international banks, right? That are creating funding sources in US dollars. Just to get on a level to make sure that everyone in the audience is on the same page, I'd like to start with the traditional system that people think about existing today, right? Which is top down and governed by the Fed. So could we just start with a brief description of what that monetary system looks like, why we have a global reserve currency in the first place? And I think by outlining then we can get to this Eurodollar system and how it's different.
Well, I don't think there's actually two different systems. I think there's an intellectual framework that we're all taught in college and gets reinforced in the media that never actually existed. I think it was oversimplified to begin with. What we're all taught is, back before quantitative easing, the top-down approach was the Federal Reserve would move the federal funds rate up and down, and that would signal to the banking system to either create more credit or to create less credit, right? If Alan Greenspan raised the federal funds rate, what that was supposed to mean was that it made it more expensive for maturity transformation, which was banks borrowing in the short run, lending in the long run. And so if Alan Greenspan raised the federal funds rate, what that did was that supposedly it constrained banks because it was more expensive for them to borrow. I don't think that was ever actually the case. I think that's just a myth that was perpetuated to try to explain why it seemed like Alan Greenspan had all this power and authority. The banking system was far more complicated, and as I mentioned before, it contains its own subset of constraints that often supersede whatever the Federal Reserve is doing. So, not to derail the conversation and digress too far, but I'm not really sure that the intellectual framework that we've been given for a very long time was ever really appropriate to begin with. I certainly think it was oversimplified as a public narrative to try to give the public a sense of what monetary policy was supposed to accomplish, but I don't think that was any way realistic, especially when you think about this Eurodollar system didn't show up in 2008. It's been going on since the 1950s, and it really took off in the 1960s. So while all this stuff was going, while Alan Greenspan was playing around with the federal funds rate, in the background, you had this global monetary system, this global dollar system, which had really taken over things long before anybody heard of subprime mortgages.
Yeah, and I think the other thing that's important to understand in all this, and this probably this is more big picture, and it brings in the politics side of it a little bit, is that if we're talking about a global reserve currency, we're talking about kind of a currency that is used worldwide for general trade. And it just typically happens that there is one country whose domestic currency ends up being the global reserve currency. And part of the reason that it ends up that way is that it's enforced by that country and it is provided by that country. And it just also so happens that it's usually the global superpower that has the global reserve currency. And, if you look back into the 70s, part of this whole transformation of the Eurodollar market really is when, Nixon struck the deal with Saudi Arabia to price all the oil in dollars. And then, they would sell in dollars and then they would use the dollars to buy US Treasury notes. And again, and then, with oil being priced in dollars and the whole world needing dollars, then other countries needed dollars to buy oil. And so then they would save their reserves in dollars. And again, this is all kind of, it wasn't necessarily mandated by the U.S., but it was strongly suggested, right? And we built army bases all over Saudi Arabia and provided, defense for the family of Saud from Saudi Arabia. And it all, again, it's not only that, but it's part of that because as a global reserve currency, you have the power to print money. And you have the power to print global money, and you can kind of over time, you can debase your money. You can get away with murder, quote unquote, better than a country who doesn't have the global reserve currency because you have so much demand for your currency. And what I mean by that is you think about all the money that has been generated or printed or however you want to define that, the whole money printer go burr meme kind of drives me crazy, but I guess it is accurate. If you think about all the new capital that's been injected into the system over the last 12 or 13 years, and yet that same time period, the dollar has risen versus other fiat currencies. It's because there's great demand for the dollar. If a frontier country printed that much currency, you would see dramatic amounts of inflation. And in fact, you have seen it in places like Venezuela and Argentina because there's not external demand for their currency. And so it is a great advantage to have the global reserve currency, but you can get to a point where it becomes a curse, and we may be kind of entering that time period. And there's this famous, theory, for lack of a better word, called Triffids Dilemma, which says, if you have a country whose domestic currency is used as the global reserve currency, you will eventually get to a point where the needs of the domestic economy come into conflict with the needs of the global economy. And we are kind of right in the heart of Triffids Dilemma right now. This is how I see it. Now, again, Jeff may disagree with this, but when Trump came in and with his "Make America Great" policies, and he's trying to run a trade surplus rather than a trade deficit, that just doesn't really work with a fractional reserve, global reserve currency where the domestic market has to provide plenty of currency for the rest of the world. And so we're in this battle of what is good for the U.S. economy versus what is good for the global economy. And it's led to a number of problems. And I think it's kind of led to the knowledge, or at least the awareness, of this whole Eurodollar system.
I take a more pragmatic view of things, especially the development of the Eurodollar system, which happened long before Nixon went off the gold standard. The Eurodollar had replaced certainly the British pound as co-reserve currency, as well as took over the monetary functions of the global reserve in the 1950s and 1960s. Yeah. And by the way, I mean, the U.S. authorities and the Johnson administration were okay with that because, as you pointed out, Robert Triffin said in 1960, look, if you have a national currency become a global reserve currency, there's always going to be a natural tension. And under the Bretton Woods standard, that meant that tension was in terms of gold, which was the U.S. only had so much gold, but it needed to supply currency to the rest of the world. Why did it need to supply currency to the rest of the world? Because that's what a global reserve currency is. It's a mitigating factor. It's a mediating factor between often very different systems that they can talk to each other and not just trade with each other in merchandise goods, but also financial flows. If you're somebody in Sweden and you want to invest in Japan, do the Swedish banks have a lot of yen lying around? No. It's much easier if everybody has a common currency that they can appeal to directly, so that they can, a Swedish investor can invest in Japanese firms or whatever, because Japan and Sweden both need dollars. They have dollars readily available. But that's what Triffin was saying, is that in a national currency, to have dollars available all over the world, that can create a lot of tensions. And I think what happened in the 60s especially was nobody really knew how to go off the gold standard. How do we keep this globalization effort going But how do we also resolve the problem that this is, there's not enough gold in the United States for all of these dollars all over the world, dollar liabilities all over the world. And so they took the view of what was called benign neglect, which was, we'll let these banks create all these US Eurodollars out there, and we won't do anything about it because we don't know what else to do, essentially. And I'm oversimplifying quite a bit, but that's really what happened in the 60s was that, okay, there's this offshore money market developing, and US banks are starting to participate in it very heavily. And there's all sorts of money creation out there in this global marketplace, this offshore Eurodollar system, but it's taking the pressure off of us and our gold reserves. Therefore, we'll take a hands-off approach and we'll just let this thing go. And there were a lot of people in the 1970s in particular that said, wait a minute, exactly the stuff you were talking about, Brent, earlier on. There's nobody out, there's no regulatory agency out there, there's no central bank out there. What if this thing starts to go awry? What if there's a bankruptcy, God forbid? I remember there was a transcript, an FOMC transcript from 1969, where Charlie Coombs, who was the open market desk operator at the time, said, what happens if a German bank goes bankrupt in the Eurodollar market? What's going to happen then? Well, it took, almost 40 years for us to find out, but that we found out that it wasn't good. Right? And it's a pragmatic thing because there's really nothing else. How does a global economy actually work? It needs money. Money is a tool for all of these systems to work together. And really, the only way to answer it is this Eurodollar, this bank-centered system, because nothing else has worked so far.
Yeah. I kind of want to summarize what both of you are saying. That's always a little bit dangerous when Jeff is on the call here. I'm probably going to get corrected, but I'll give him my best shot. So basically what it seems like is the reason why we have a global reserve currency is to finance trade, right? There's sort of a natural monopoly that needs to happen around a currency, whereas just for it to function as an effective medium of exchange, we want everyone using the same currency. There was a bit of a problem when the Bretton Woods system was rolled out in that there was a limiting factor, which was gold, which we essentially got rid of, and now we have the fiat dollar system that exists. But even without the limitations of gold, it was difficult or not really pragmatic for the United States to print enough dollars to fund the amount of global trade that wanted to happen. So what we saw is this emergent system, which is the Eurodollar system, which kind of exists to plug in the holes, right, and to finance, to create financing between countries when there's a shortage of U.S. dollars. Now, I think this is the part where
plausible deniability, right? That we can have all this money creation, but it's not our fault. We're not doing it. It's the banking system. That's
smart. Yeah.
The government's not doing it. It's just these dollars are out there in the world. It's not ours.
There's one other little part too that we don't need to go down this rabbit hole, but there was also like the Eastern Bloc nations in the 60s, 70s, in the height of the Cold War. They had dollars. They were afraid that if they kept them in U.S. banks, they could be confiscated or, put regulations on or whatever. And so they wanted to hold dollars because there's a global reserves currency, but they didn't want to hold them within the United States jurisdiction. So I think they moved them to Canada, and then they moved them to Europe. And so anyway, I always like to just reinforce that while Jeff is completely correct on all the economic side of it, there is a political variable in here as well.
There's also the central bank variable too. As part of benign neglect, one of the reasons the Eurodollar system flourished was that all these overseas central banks, especially the 1960s, were the biggest participants in it. For example, the Bank of Switzerland, which would get, because they had a peg, they had to manage their currency peg to gold. Whenever they had too many dollars flowing into Switzerland, they were obliged to convert them into U.S. gold. What they realized in conjunction with U.S. authorities was they could circumvent the Bretton Woods system by swapping those dollars into the Eurodollar market, thereby allowing the Americans to keep their gold, letting those dollars go into the Eurodollar market, not as physical currency, but as a liability to the central bank. And the whole thing just worked when everybody just kind of turned a blind eye to it. In a lot of ways, they didn't understand what they were doing, but really it was, really benign neglect. We don't really care what's going on because it seems to be working. And so long as it seems to be working, we'll just kind of take a very hands-off approach to it.
Well, and it's a very good point because it happens on a smaller level in everyday lives. Like as long as people are making money, little problems, let's not worry about it, right? Making money solves a lot of problems. Like it's just like when you're on a sports team, when you're winning, everybody's happy. But when you start to lose or when things start to go wrong, then every little thing starts to become a problem. But when you're winning, it's all good. And so I think that translates to Jeff's point, as long as things were working, credit was being expanded, economies were growing, turn the blind eye or the plausible deniability, and let's just let this thing rise.
Yeah, one of the things I think you talk a lot about, Brent, is emerging markets. Why would emerging markets, especially China, go along with this system? Well, it's just what you said, right? I mean, the Eurodollar system and the globalization wave that started after World War II turned all of these emerging market economies upside down. They were agrarian, very primitive, very simple. All of a sudden, they're modern, superpower type economies. So, why wouldn't they go along with it? Because it was making them wealthy and rich. And so long as that was going on, they might have seen and they might have been aware of some of the downsides, some of the imbalances, the bubble tendencies. Why are so many foreign banks interested in my economy? That kind of stuff. They didn't care about that because at the time it was working really, really well. And so it was hard to say, we object to this kind of a system because, we see that there's problems with it. It's always down the road. We'll deal with it at some point down the road. And then once you get down the road, it's too late.
Yeah.
Kicking the can, so to speak. Effective policy decision, apparently. So I really want to put as much as possible, almost a ring fence around this definition of what the Eurodollar system is. So if you look it up on a simplistic definition, which is just, if I, Mike, take $100, $100 US dollar bill, go over to France and deposit it in a bank there, then that will become a Eurodollar, right? I think that's a very narrow definition of what we're talking about. And I think what we're talking about is a system that is much more large and more impactful. So I know it's a tall task, but I'd put the question to either of you. Could you define what we are talking about when we're talking about the Eurodollar system?
Well, it's what happens when that dollar goes. What happens to it from there? So you've deposited $1 in France. Well, what does that bank in France do with it? Well, usually nothing. It sits in a vault, but then it can create all sorts of liabilities predicated on that dollar because it says, I have $1. So in a fractional reserve system, as Milton Friedman showed in 1969, there's a multiplier effect for all of these foreign dollars. And they don't even have to be physical dollars. They could just be any kind of US dollar liability or asset in the case of the bank that holds it. So it's what happens once those dollars are offshore. What happened a long time ago when those dollars were offshore is they began to expand. And so you have all sorts of liabilities piled on top of what used to be your single dollar bill that is in the vault for this bank in France, and that it doesn't stay in just one place. It gets multiplied through all of these ledgered transactions between banks that are operating all over the world. So your $1 that goes to France could end up as multiple dollars in Asia, South America, Africa, all the way around the world. So that's really what the system is, the Eurodollar system.
I'll give you a really simple analogy. So I grew up in a little town in western Nebraska, about an hour from the Colorado border. And when I was in junior high and high school, the laws around buying alcohol were different in Colorado than they were in Nebraska. So you can imagine people that were 18 in Nebraska couldn't buy beer. But if you went to Colorado, you could. So you would get in your car, you'd drive an hour to Colorado, and all of a sudden you're still the same person. So it's like you're still the dollar, but now you're in a land that has different rules. And then you buy your beer, and now you've got a young, irresponsible person who's drunk. Now that's the Eurodollar. You're still a dollar. You just don't have the rules are different. There's nobody trying to catch you, and you're irresponsible. And so, that'd be my way to explain the Eurodollar system.
The drunk dollar.
The drunk dollar.
I like that. Drunk
dollar. Drinking. That's an analogy we can all relate to, Brent.
It's the same. It's just the same thing with different rules. It's the same commodity with different rules. Okay. And when rules are relaxed, people will take them, as far as they can.
Absolutely. So what are the implications of this system existing? I think in other, and also if you could try to, order, I know it's difficult to measure what the size of this market is, but both of you have indicated that the size of the Eurodollar market is actually much larger than the size of the market for just US dollars. So what are the implications of a large and very impactful system like this existing outside of the reach or the direct reach of US regulators?
Well, again, that's a very good point because we actually have no idea how big the system is. I mean, we don't really have any good idea. I mean, there have been a few efforts, especially in the wake of 2008, to try to figure out what's out there. But we have a bunch of we have blending of geography and jurisdictions. We have blending between what's credit, what's money. And so you really have to go into what are, bank footnotes to try to figure out what are all of these banks doing in each other. And then there's double counting. There's also, because this Eurodollar system grew up under benign neglect, plausible deniability, all of these things, nobody has ever undertaken a real determined effort to study what goes on out there. That includes not just quantitative measures, but also qualitative measures. What actually is a Eurodollar in terms of money? What kind of transactions would qualify? Alan Greenspan said in 2000 that the proliferation of financial products made it impossible to even define money in the modern sense. So we're already starting from, again, literal shadow money. We don't even know how to define it. We can't quantify it. And so we're kind of trying to study and to understand a system that is not easily understandable, that is not, you can't observe it, you can't feel it, you can't touch it. So, to understand the implications, to get a sense of it, it's really a very difficult and esoteric process.
Yeah, and I think what I would say is I'm not going to sit here and pretend that I know exactly how big it is, because there's people, like Jeff, and maybe there's another 50 people in the world who understand it as well as Jeff. And, they probably all disagree, right? And I don't think they have an idea of how big the market is. This is what I know for sure. What I know for sure is that it is a huge market. Very few people understand it. There's no regulators, and that the people who do sort of have quasi-regulation over it are PhDs who've never acted in the real world. And so it's Jeff, I got to plug Jeff here for a second. I don't always agree with everything Jeff said, but he put out a report a week or so ago, and it was titled "These Idiots." And I just saw that headline and I started laughing, because it's true. You've got these PhDs who are very smart people, but I just think they're completely misguided. Their hubris is off the charts. They think that they can control this massive monster that's been created that nobody understands. And so my point with all of this is we have a system that is inherently unstable. Fractional reserve banking is a system through which it has to continue to grow, or else it crashes. And if it doesn't continue to grow, then you have bad things. And the fact that we have a huge system that nobody understands, that nobody regulates, and that nobody has their arms around, or even the mechanism by which to solve it if they did understand it, I think really bad thing is going to happen. And so I'm preparing for that really bad thing to happen. Now, and the people who tell me that the central banks have this all under control, I fundamentally disagree.
Well, again, what Michael was saying about the implications of the system, even though we can't observe, we have no idea how big it is. We know it's substantial. We know it's significant because of how it impacts everything. I usually use the analogy of quarks. Quarks, every physicist in the world, every physicist around the world will agree that quarks exist. They're a fundamental property of nature, yet nobody's ever observed it. They know it's there because of how it interacts with other things around it. And so that's what we're really doing when we're studying the Eurodollar system. We can't observe the Eurodollar system directly, but we understand that it disturbs markets, it disturbs economies, it disturbs any number of things that we can see. And so we're seeing the implications of monetary dysfunction, especially, as we talked about before. What was 2008? It was a very big disturbance in the shadow money system that, as Brent, you pointed out, the PhDs at the Fed had no idea it was there. They had no idea they should be paying attention to it. And of course, they didn't actually solve the problem. They just hoped that it would go away and that they could then take credit for that going away, saying, oh, we saved a bunch of jobs. And it didn't get worse. So, the implications are for the global economy, for the global marketplace. And therefore, we have to pay attention to first of all, understand that we can't really observe. We're behind the eight ball because we don't have any good data. We don't have any good direct observations of the system. But yet we know it sets the agenda, it sets the direction for the entire global marketplace, the global economy, financial systems, everything.
I just want to point out for everyone who missed, we've got two analogies here so far. Brent was talking about drinking when he was a kid, and Jeff just brought up quarks.
Not me. People I knew. Not me.
People you knew. Sorry.
People I knew.
People you knew. Me. Okay, great. So we've got about 10 more minutes here before audience questions, and I really want to dig a little bit more into these implications, and I want to look into the past at an example, which both of you have just referenced so far, but the great financial crisis in 07 and 08. And I want to look to the implications for understanding the current situation that we're in, because I know one distinction that is important to both of you is when that money printer go, brr, Brent, that you were referring to before. They're not actually creating new. There's a difference between creating money and just creating new money. So I want to start with 07 and 08 because it's a pretty big contention. When people think about the GFC, they think about the subprime mortgage crisis. But I think both of you would say that was actually part of a larger story, which is tension in this Eurodollar system. So do you want to describe how this emergent large system is actually a large cause of the GFC?
Well, put it simply.
Good.
Well, okay. To put it simply, the global financial crisis in 2007, 2008 was a global dollar shortage. That's really all it was. And so it manifested in very different ways, which ended up being in terms of liquidations across markets, which is what people pay attention to. When the stock market crashed, that was really tied to these liquidations. So it's a global dollar shortage. But I think the larger issue here, especially moving forward under quantitative easing in these types of regimes, is the issue of bank reserves. And really, people see that, the Fed creates these bank reserves. We're told it's base money. It goes into the base M1, M0 statistics. And therefore, it looks like, oh my God, this has to be inflationary because look at all this money printing the Federal Reserve is doing. And that's understandable because you look at it, the Fed's balance sheet was this, and now it's this times 2. So it looks like the Fed is engaged in money printing. And by the way, the Fed wants you to believe that because they want you to think inflationary and therefore act inflationary. But in reality, that's not the entire story. In fact, I would argue it's not even the most interesting part of the story. What happens when we talk about a global dollar shortage, what we really mean is monetary destruction taking place in these places you can't see. So in this offshore Eurodollar system, however much money there was, out there that we can't really define, but however much money there was, come 2007, it started to go the wrong direction. It started to shrink.
Exactly.
And so what the Fed was trying to do was to create an asset that could be used in place of all of that money we never saw disappear. And so we have to at least start with the concept of net liquidity and net money. And when by the time the Fed actually acted in any significant way in October 2008, obviously it was already too late because the amount of monetary destruction that we never saw was enormous. And so the Fed was already starting from way, way behind. Even if you assume that bank reserves are base money, which I don't agree that they are, I think there's something else, but that's a separate conversation. But the point is that people see the Fed's balance sheet go way up, and they think that has to be money. That's adding new money to the system. That's adding trillions of new money to the system. What they don't see and what they don't appreciate is the money that's been destroyed in the shadow system.
So I'm really glad you brought this up, Jeff, because this is a point that I've been trying to make all year, is that the first thing, again, you got to look at this from the central bank's point of view and from, then our side of it. So there's two different sides. The central bank side of it, to Jeff's point, is they are printing reserves. They're telling you it's money in the hopes that you will believe them and then go out and extend more credit. Because in the monetary system, most of the credit, most of the money is actually created by commercial banks extending loans or shadow banks extending loans. The central banks print the reserves, they forward guide that we're going to do more of it in the hopes that it will change behavior. But if the commercial banks don't lend, and if the extension of credit is not continued, it doesn't work. And so they can print all the reserves they want. If it doesn't get into the real economy, it doesn't really matter. So that's the first thing. The second thing is that central banks are reactionary agencies. They're not proactive agencies. If the central bank, people always tell me the Fed is going to print $20 trillion and it's going to be massively inflationary. And I always say, if the Fed is printing $20 trillion, it's because the global markets are melting down and they're trying to fill a bucket that's leaking.
Yeah.
They are not filling a bucket that's they're not pouring water into a bucket that's full and has no holes. They're pouring water into a bucket that is leaking like crazy, and they're trying to keep it level. And they're trying to convince everybody to go extend more credit. And it's just, and it works. I mean, look at the last 2 or 3 months. They have printed a lot of reserves and people have believed them, and look what the markets have done. Now, can that go on for a while? Yeah. I mean, many people thought in 2008 the whole thing was coming down. Here we are 12 years later, and the same, kind of bullshit stuff is still going on. Sorry for the language, but it is.
There's also two different market views, right? We're talking about stocks versus bonds.
Oh, yeah.
You're right. The stock market has bought hook, line, and sinker that there's a bunch of inflationary money.
Very good point.
Where the bond market is saying, we've seen this before. We know this game. There's no money here. I mean, look at inflation expectations. Inflation expectations are absolute low levels. So, I think, but that it gets back to the point you and I were making at the beginning, which is it's not a top-down system. It's a bottom-up system. So the Fed is trying to force these bank reserves onto the banking system, and the individual banks are saying, we've got our own problems, man. We can't do it. Even if we wanted to. And we talked about this before, the negative interest rates in Europe and Japan, why they don't work. Negative interest rates are essentially trying to punish banks into doing it. Like, hey, you're going to create money or I'm going to penalize the hell out of you. That's what NERP is. And what banks have done in Europe and Japan is say, well, you're just going to hurt us because we're not going to lend, we're not going to create new money. Because we have our own problems. We have our own balance sheet problems that override any inputs that you try to put on top of us, negative interest rates, quantitative easing, bank reserves, whatever it is, we're just not going to lend because we have these constraints in our system, which are tied to this Eurodollar liquidity stuff that we've been talking about. So
and it just goes back to the Fed and their models, and what works on a model doesn't necessarily work in the real world. It's just, again, so that there's two different systems right there. The system that works, the system that works in the central bank's minds, and the system that works in reality, and they're not the same.
And there's a historical component to that too, because, Alan Greenspan in the 1990s used to lament all the time that they could no longer define money. And he worried that might be a problem. In fact, his most famous speech, the 1996 Irrational Exuberance speech, everybody thought that was about the stock market. It wasn't. What he was actually saying is, because we can't define money anymore, how would we even know if the stock market's behaving rationally or irrationally? That's what he was really saying. Now, put that into a monetary policy context. When you're confronted with something like 2007, 2008, you can no longer define money. You haven't really tried in 30 years. What do you do then? It becomes not to portray central bankers as sympathetic, but really they'd taken their eyes off the monetary ball for so long. When they were confronted with a monetary event, they really had no idea what to do. So you're right, Brent. These PhDs are incredibly intelligent. They can create the most elegant, breathtaking mathematical models, but they aren't worth a nickel in the real world because they don't take into account anything they're not realistic in taking into account what actually has happened especially the monetary system.
Well, and again, in many ways, they come up with 100 different ways to do the same trick. And the trick is the extension of credit or continuing the flow or the extension of the dollar or the Eurodollar system.
Hey guys, I almost hate to cut you off here, but we're coming towards the end of our interview portion. We have a ton of audience questions that I want to get to, as many as possible. But I would just end with this, and this actually is a question that we got from the audience. How do you see this all playing out, right? We're talking about a system that seems very large and impactful, and it's not regulated, and it seems like there are some downsides. I mean, how do you see the interaction? How do you see this all playing out? I guess. I'm asking you a hard question here. I'm putting you on the spot right at the end, but... I mean, how do you see this all playing out? Is this sustainable long term?
So I'll take it first. But I mean, the long story short is and I'll be fairly brief. The long story short, it is not a sustainable system. And I've said this 100 times, but a fractional reserve system is a system that must grow, and if it doesn't grow, it crashes. And so maybe it will continue. I don't know how long it will continue to grow, but I know it's an inherently unstable system, and I'm convinced it will crash. And when it crashes, because we are now on a dollar standard and not a gold standard, I feel like the underlying collateral, which is the dollar, is going to have a super spike. And that is going to just kind of wreck the global economy. So that's my base case.
Yeah, I think that puts it pretty good. I mean, look, the system, you're absolutely right. It has to grow or it doesn't work, right? I mean, that's really the issue. And in fact, it stopped growing in August of 2007. So we're now in year 13, approaching year 14 of a system that's not really working. And so, how does it play out? Well, it's impossible to predict, except that we know that something is going to happen. We don't know when. I agree with that on that account, Brent, that we have no idea when it stops working, but it has at least kept things reasonably working for the last 13 years. As I say, it keeps the lights on at the bare minimum. But we haven't had any actual economic growth in the United States or anywhere else for that matter. And we're dealing with the consequences beyond economies and markets in terms of social consequences, political consequences, divisions, deglobalization. So we're already into the phase where we're dealing with, beyond the monetary system, the financial system, and even the economy. So how much longer can it go before something happens? And I actually look, it could go one of two ways. It could go like Brent says, where I think, the fiery end of the Eurodollar system is not where the dollar plunges to zero value. I think it goes the other way. It goes up to infinity. It becomes in such short supply that it's essentially, its value is impossible to calculate. Now that's the worst case scenario, and I hope to God we avoid that kind of a scenario. And I have to believe in some faith in humanity that before we get to that far, we might have a situation where, God forbid, maybe a central bank or somewhere, the BIS, somebody stops and says, hey, there's a problem here that we need to fix before we go too far. Maybe that leads to a Bretton Woods part 2. Maybe we have some smart people get together and design a system that actually works. Maybe even replicate some of the best features of the gold standard, some limiting factors, some rules, some transparency behind this system. And that is that would be a hugely positive result, where I think if that scenario plays out, the implications are massive economic growth worldwide and all the good things that go along with it. And not just massive economic growth over the short run, but sustainable stuff like we saw in the 1950s. So I think, there's two ways that this thing can go. And, I have to really hope that we get it fixed before it gets to its limitation, because I agree with Brent. This thing it's on a ticking clock, and we don't know when that clock reaches zero.
I'd say I agree with Jeff. That would be a nice scenario. I think what Jeff just described, I think a good way to describe what Jeff just described would be to say it's a pleasant fiction.
I agree with you.
I've done that, the pleasant fiction.
It's nothing more than fiction at this point, really.
Yeah.
Thank you so much for that. That was a really enlightening talk. And for those of you who might have had to leave early, we'll have this on demand for anyone who wants to watch. We've got about 35 audience questions, and we've got 13 minutes. So, Jeff and Brent, I would ask you to...
Jeff will be happy to answer all of them.
We'll do a bit of a rapid fire here. So just starting with this one here. Round. I'd love to hear Brent and Jeff's thoughts on the dollar presently. It seems everyone is forecasting an inflation and falling dollar, yet it sounds like they're saying the system is at risk and there's a dollar shortage. Thoughts?
I think between now and the election, all bets are off. If it could go 10% either way, wouldn't shock me at all. There's a huge treasury balance at the Fed, the Treasury has a huge balance in their checking account at the Fed. I'm not exactly sure what they're going to do with that. That is the wild card for me. But as we get further, a year, 2 years from now, I expect the dollar to be dramatically higher than it is today.
Yeah, we've heard about the dollar destruction and inflation for the last 13 years, and it never happens because nobody ever factors the Eurodollar system into their analysis. They're just looking at the Fed's balance sheet and extrapolating from there without thinking about net in terms of net liquidity or even what bank reserves actually are. So, the idea that this is going to be inflationary, again, look at the bond market. The bond market is already telling you it's not. So no, I don't think. I think that the issue with the dollar is it doesn't go up in a straight line. It's very lumpy. It goes through bursts where it screams higher, like we saw in March. And I expect that would happen as the dollar shortage becomes acute again, probably over the next last half of this year, maybe into next year. I would expect that there would be another dollar episode where it jumps.
Okay. Next question here. What's the risk that with Fed ZIRP, foreign central banks will sell their treasuries for gold, displacing the US dollar as a reserve currency and collapsing Eurodollar markets and foreign shadow banking systems?
Zero.
I think it's close to zero.
Look, the foreign central banks are already selling their treasuries, and they have been doing that heavily since 2014. And the reason they're doing it is because they're confronted with this dollar shortage. Selling treasuries is a byproduct or a bypass of the dollar system. It's a way of trying to fill that dollar demand by mobilizing what are essentially reserves. So when you see foreign central banks and foreign governments selling treasuries, that's not because they hate the dollar or they think it's inflationary. They're selling them because they're telling you their local banking system is experiencing the dollar shortage. So if you see foreign sales of U.S. treasuries in particular, or any U.S. dollar assets, that's a dead-on accurate signal of this shadow dysfunction, this shortage.
It's an indication of demand, not an indication of anything else.
Exactly.
Excellent. Okay, guys, this is kind of a combination of several different questions, but you both talked about the rules for US dollars and Eurodollars being different. What are some of the most key or most important differences in between these two forms of dollars?
Well, one is regulated and one is not. One is measurable and one is not. One has a solution to fix it and one doesn't. That's my opinion.
Yeah, I think it just comes back to what we said before. The regulated domestic system is a top-down system where there's all sorts of regulations. There's sometimes onerous regulations. There's a central bank that sort of a central bank standing behind it. The Eurodollar system is a bottom-up system. Often ad hoc networks appear and disappear. I think, Brent, you said you call it the Wild West. That's probably a really good analogy because it's an individualistic system where it's defined by these bottom-up characteristics rather than the attempt, what we all understand as a top-down approach.
Here's another question. Why does the Fed not care about the Eurodollar shortage? It causes U.S. stock market crashes, which the Fed can't afford to let happen for many reasons: tax, pension, treasury credibility, etc. So, and I guess I would just add on to that, are they truly aware of what's going on in the Eurodollar market, and what, if anything, are they doing?
They're aware that there is a dollar market, but it's outside of their jurisdiction, number one. In fact, go back to 2007 when the first dollar shortage showed up. They had lots of different discussions about what should they do about it. And a lot of them were centered around, should they do anything about it? Because a lot of the Eurodollar problem in the early global financial crisis in 2007 centered on banks in London. And so their discussions were revolved around, is that a Bank of England's problem? Even though these banks in London were trading in US dollars, they were banks in London. And so the Fed was taking the approach of, maybe this isn't our issue. It's an English issue. It's a British issue. It's not a Federal Reserve issue. So that's number one. The Fed's mandate ends at the US border. But however, they were forced to realize that the implications of allowing the system to go as it may, including in terms of how it was in reverse and crashing in 2007, 2008, causes backlash inside the US too. That's where dollar swaps came from. That's where all of these foreign-facing US dollar activities from the Federal Reserve showed up from. It's the idea that, okay, there's this dollar system beyond our control, but we got to do something. So we'll swap dollars with foreign central banks and allow those foreign central banks to take care of their own dollar problem. So there's more to it than that, but just intellectually and ideologically, the Federal Reserve takes a hands-off approach to the Eurodollar system because statutorily their authority ends at the U.S. boundary.
Yeah, I'll just go with that answer.
Well, there's more to it than that. Intellectually, the frame, to talk about the monetary framework too. But the easiest answer is to say the Fed says there's a foreign dollar system out there, but it's foreign. It's not our problem.
Okay. All right, this is a great question because it's actually something that we didn't get to, but we talked about before this webinar. In this crisis, how effective are the Fed's new dollar swap lines and repo facility with global central banks in addressing issues with the Eurodollar system and the global dollar shortage?
So let me just address it from the very big picture, and then I will let Jeff go into some details if he has any interest in doing that. But in the very short term, it can provide some help. And I think you just look at the last couple of months and it has helped provide liquidity to the markets. But what it doesn't do is it does not solve anything. The only thing it does is it makes the problem bigger by perpetuating the current system. It's just a further extension of credit. It's a way to get some quick dollar collateral into the Eurodollar market, which can then hopefully spur further Eurodollar credit extension. But further dollar credit extension actually increases the demand for dollars. So it does not solve the problem. It makes it bigger. And while it can kick it down the road, we will eventually come up upon it again.
Yeah, the only thing I'll say about it is I don't even think it's that good. I think it's more window dressing designed along with quantitative easing to make people think that it's effective, as long as you don't ask any questions about what really happens with these dollar swaps, which is really all these policies are designed to essentially fool people into believing something substantial is taking place. But but dollar swaps in particular, if you actually look at the data, especially the TIC data, Treasury International Capital, what you find is as these dollar swaps, as the Fed swaps dollars with foreign central banks, Then banks in those overseas jurisdictions transact with the central banks. But who are the banks that are actually transacting with these foreign central banks? Well, it turns out it's U.S. banks. It's their foreign subsidiaries are borrowing dollars from foreign central banks that are swapped to them through the Fed. And then those foreign subsidiaries of U.S. banks transfer those dollars back onshore. So these are overseas dollar swaps that go over to a foreign central bank, are bid by a foreign subsidiary of a U.S. bank, and then transferred back into the United States. So how does that help a global dollar shortage? It doesn't. It's all window dressing. It's all a shell game designed to make you think something positive has happened. It's really ridiculous.
All right. I've got another hard one for you here. So you were given carte blanche to fix the Eurodollar system. How do you go about doing it?
Blow
Resign.
it up.
Yeah. Go.
Oh man, that wasn't hard at all. All right.
No, I think Brent and I would agree on that. I don't want to speak to you, Brent, but I think we agree on this. The system doesn't work. We need to start over. And, start over is probably too much. I mean, there are some good elements to the Eurodollar system. It's a modern system. It's a virtual currency system. There are positive aspects of it. And I think it needs to be reformed substantially so that there's some structure to it. And more than anything, there has to be some transparency to it. We have to know what goes on. Everybody who operates in it has to know what everybody else is doing and in what terms. And so that, that was what the beauty of the gold standard was. Under the gold standard, everybody knew what the rules were. It was, you had gold in your pocket. We knew what it was. And so there was no need for, an entire cottage industry surrounding, lobbying and laws and rules and regulations and how do banks operate and what levels of compliance are involved. All these things that serve to push the system further and further away from the public. And so, maybe there are some elements of the Eurodollar system that are worth preserving. I don't know, but it needs to be substantially reformed so that the product on the other side of it probably doesn't look too much like it does now.
Yeah, I mean, I think one thing to keep in mind with all of this is, this is the thing I always come back to is I can wish for something all I want, and there's certain things that I would like the monetary system to be. But, the reality is that the politicians and the monetary authorities don't want it the way I want it to be. And they have a lot more power than I do. So it's important to kind of figure out it's fine to understand what you would like to see happen, but I think it's more important to understand what's actually going to happen. And, I don't think that we're going to go back to a gold standard anytime soon. I don't think the monetary authorities are going to go for that. Now, if they did, that's fine with me. I think that would be a fantastic system, but I don't think it's going to happen. I think what's going to happen is that the monetary authorities will continue to try to build, on top of this Frankenstein that they've already built. And eventually it will have such a climactic disaster that they will have to start over.
Awesome.
Yeah, I think that's really the issue. Really, the point is, at what point do we force their hand into acting? And I would hope that it's before the really bad ending, that they can, we can get them to wake up before then, so that they can act just in time to save the system. And I realize that's probably too Pollyanna-ish, but that's
the pleasant fiction. It's the pleasant fiction
to shoot for, right? I mean, otherwise we were really talking about some bad stuff.
Yeah,
great. So guys, one last question just to end on maybe a pragmatic note. So I think we've discussed a lot of great information here. Some of our investors in the audience are wondering how some of this information can be translated into actionable advice. So anything that you're comfortable sharing just in terms of an asset that you like or a trade that you think would be particularly interesting. We've got 2 minutes left here.
I'll just reiterate what I've been saying for a couple of years. I think this is going to end in a fantastic spike in the dollar. The asymmetry lies with the dollar getting stronger, not getting weaker. You look at prices around the world. You look at trade positioning. You look at forecasts by global financial institutions. Everybody thinks the dollar is going down over the next 2 or 3 years. All the positioning says the dollar is going down over the next 2 or 3 years. But the asymmetry lies, and they say that because the dollar has to go down for the system to work. And so that's why it's all forecast that way. But the asymmetry lies with it not working out the way everybody says it needs to work out. And so I can't give advice on individuals of how they should trade this, but I'm telling you the asymmetry lies to the upside on the dollar.
Yeah, I would just add the same thing. Deflationary, however you want to invest, however you want to structure investments, just understand what these market signals are telling you, what the system is telling you is that I guess Brent said the risks are asymmetric toward deflationary circumstances, which is dollar positive. So you have a rising dollar, deflation, not inflation.
Excellent. All right, gentlemen. Well, thank you both so much for your time here. This has been
Happy to be here.
just such an interesting conversation, and we really appreciate it. If anyone would like to find you, where can the people on the webinar find you? If they'd like to just learn more.
You can go to my website, just www.santiagocapital.com. You can email me, brent@santiagocapital.com. I'm very active on Twitter. I do a number of interviews here and there. So I'm happy to, I always say this, feel free to send me a message. I'll do my best to get back to you. I get a lot of them, but I do like interacting with people. So feel free to reach out.
Excellent.
Yeah, I'm at alhambrapartners.com. I publish a lot of articles, blog posts, research reports around the Eurodollar system, implications of it. I'm also working on a website, a related website called Eurodollar University, where myself, along with a couple other people, are looking to really get people's attention and then try to explain some of these things that go on in the system so that they can interpret the world around them, because economics and traditional education has done such a poor job of really explaining how things actually work, that it's fallen to somebody like me to try to bridge that divide, to fill in the shadows, so to speak, to shine a light on what's really going on. So look for that too, alhambrapartners.com and then eurodollaruniversity.com.
Excellent. Thanks very much, Jeff and Brent. For those of you who enjoyed this webinar, stand by for incoming information about future episodes that we've got planned. But for now, gentlemen, thanks very much again. And to the audience, thank you for joining us today.